Alphabet just dropped the recent earnings report, and I would say it smashed my expectations.
Alphabet beating street expectations for a second quarter. Earnings and revenue coming in better than expected. The company saw strong results across search, also cloud.
Google Search grew 12%, going against the narrative that AI will disrupt Alphabet's search empire. In this video, we'll analyze Google's business model, their competitors, and important news shaking up the industry. I'm hoping to paint a clearer picture if AI could threaten Alphabet. We'll also take a look and see if insiders, hedge funds, and superinvestors such as Bill Ackman and Chris Hohn are buying or selling right now. Let's start with the business model overview. Alphabet scores a stellar rating across most categories. The value proposition is all about organizing the world's information through its search engine, while also leveraging platforms like YouTube, Chrome, and Android. Google Cloud provides essential productivity tools for businesses, and AI initiatives like Gemini push innovation forward. The next stage for Google is whether they can integrate AI into their business model without disrupting their own already dominant businesses. We see stellar ratings for both secular trends and optionality, with pricing power ranked as good. The company's competitive advantage is stellar. Overall, the quality of this business model is top tier, earning the highest grade. Looking at the industry growth, the global AI market is projected to expand at a staggering 37% compound annual growth rate from 2024 to 2030. You can see this sharp rise on the chart, with the market size expected to hit over $1.8 trillion by 2030. For a company like Google, which is heavily invested in AI, this explosive growth represents a massive tailwind for future revenue opportunities. But if they fail, it might disrupt them. Google operates in the communication services sector, specifically within interactive media and services. They also have aspects from the information sector. With a total market revenue around a whopping $850 billion and a growth forecast of 12 to 14% annually, this is one of the foremost growth drivers of the planet. This industry is digital first, driven by rapid innovation, technology adoption, and advertising revenue. Due to its networking effects, it's highly scalable. It also leans towards an oligopolistic structure where just a few dominant players, like Google, hold most of the market power. This slide highlights investment research firm Morningstar's analysis of Google. Analyst Malik Ahmed Khan notes that bulls see Alphabet's advertising business as deeply entrenched, with substantial cash flow fueling growth in areas like Google Cloud, AI, and Waymo. On the bear side, there is concerns about heavy reliance on search advertising and ongoing investment into experimental projects that could pressure cash flows. It costs to stay innovative. Additionally, regulatory scrutiny remains a risk for Google's dominant position. The big elephant in the room is AI. Will AI really be the demise of Google Search? With the rise of AI chatbots like ChatGPT, analysts are questioning whether traditional search will hold its ground. The article points out that Google's monetization model, built around sponsored ads, may need to adapt as AI-powered search becomes more prominent. This is a key storyline for investors to watch, especially since over half of Alphabet's revenue comes from search-related ads. It might even determine if it's worth investing at all. In my opinion, Alphabet faces medium overall risk. The biggest concern is concentration in search and the advertisement revenue it brings in, as AI disruption could erode Google's dominance if users shift to AI-based search. There's also intense competition in the cloud space, with players like Amazon and Microsoft pushing hard. R&D spending on initiatives like Waymo is costly and not yet profitable. Lastly, global regulators are tightening the screws on privacy and antitrust issues, which could impact business operations. Lately though, Google potentially losing to new AI companies has lessened this narrative substantially. Here we have Alphabet's latest quarterly results, and the tone from management is very optimistic. Financially, Alphabet reported $96 billion in revenue, up 14% year over year, with earnings per share rising 22% to $2.3. Google's CEO emphasized that AI is positively impacting every part of the business, driving strong momentum. Search continues to deliver double-digit revenue growth, and new AI features like AI Overviews and AI Mode are performing well. Google's CFO confirmed a significant increase in capital expenditures, now projected at $85 billion in 2025, largely to meet growing demand for Google Cloud. Google faces high competitive pressure, but still holds a stellar competitive advantage. Looking at the table, Google's revenue has grown 109% over the last 5 years, with EPS surging by an impressive 246%. It dominates search with around 35% overall market share in the many fields it operates in, while Apple, Amazon, Microsoft, and Meta control their own niches. Apple, while bigger in market cap at $3 trillion, has slower growth, 46% revenue and 95% EPS growth. Amazon, valued at $2.4 trillion, has a strong foothold in cloud, with 87% revenue growth and the highest EPS growth at 258%. Microsoft, worth $3.8 trillion, is steadily expanding in cloud services. Meta has a strong position in social media, while OpenAI, though much smaller at $300 billion and hard to give a market cap since they are privately owned and not traded on the stock market, is growing explosively with 253% revenue growth last year, and they lead in generative AI. The AI revolution is shaking up this landscape, and while Google is well positioned, the next decade could see shifts in market leadership. Over the past 5 years, Google's stock delivered a strong 144% return, closely matching Microsoft and outperforming Apple and Amazon. Meta has been the standout, with nearly 195% returns, largely due to Mark Zuckerberg shifting away from their expensive expenditures into the metaverse into more profitable areas. Overall, Google remains a solid performer relative to its peers. About 40% of Alphabet's Class A shares and roughly 60% of its Class C shares are held by institutional investors, including major players like Vanguard, BlackRock, and State Street. I put the overall number at around 50%. In total, there are over 6,900 institutional holders, making Alphabet one of the most widely held stocks in the world. Institutional ownership has remained steady since late 2022, showing continued confidence from large investors. However, it is important to note that Alphabet's founders maintain control through Class B super voting shares, which accounts for only a few percent of total shares, but hold around 52% of the voting power. Looking at insider ownership, Alphabet's executives and key insiders own around 11% of the company, which is a significant stake. Over the last 3 months, there has been no insider buys, but roughly 2,860 shares have been sold, with some big trades like Google CEO selling millions worth of stock lately. While insider selling isn't necessarily negative, they sell for many reasons, including personal ones. It is worth noting the lack of recent insider buying, which could signal insiders view the stock as expensive right now. We can see this insider sentiment if we look back several years. Selling has been far more common than buying. But this is fairly typical for a mature tech company like Alphabet, where insiders often cash in on stock-based compensation they have received, not really needing to buy stock to stay invested. Now, let's look specifically at the so-called superinvestors, the most top-performing elite investors out there, tracked by sites such as Dataroma. Alphabet ranks third in overall superinvestor ownership. Value investor Li Lu holds about $382 million, which is a sizable 17% of his portfolio, while infamous activist investor Bill Ackman has nearly $1 billion in Alphabet, representing 8% of his portfolio. The ownership trend over the past 6 months has been pretty steady. It's worth noticing no one has really bought any more shares though. And famous superinvestor Chris Hone of TCI Fund has cut his massive $4 billion position by 32% for 2 quarters straight. And breaking news is that the aforementioned Bill Ackman trimmed his position by 7%. This is another cautionary sign. Hedge funds reduced their Alphabet holdings by nearly 29 million shares last quarter. Their current ownership sits around 3%, which is pretty high, but the trend is pointing slightly downward. Hedge fund seems to be more careful at these valuation levels. On a positive note, the put-call ratio is 0.49, which indicates a bullish sentiment among options traders, as values below 1 suggest more calls than puts. Alphabet's short interest is very low, with just 0.7% of the float being shorted, although that's up 13% from the previous month, and the first time since 2021 we have seen investors go short on Alphabet. It's still minimal and shows very few investors are betting against the stock. Wall Street analysts remain overly bullish on Alphabet, with the majority rating is a buy or a strong buy. The historical rating has stayed positive over time, and the overall recommendation right now is a clear buy, suggesting strong confidence in the company's growth prospects. If you want to go deeper into Google, make sure to check out my other videos. In part 2, we'll look at the financials of Alphabet, including revenue and EPS growth, dividends, and the debt situation. We'll also score the company in all these metrics and give Alphabet a total grade from 0 to 100. Then in part 3, we'll look at valuation and calculate the intrinsic fair value for the company.